As the markets are currently closed on this Saturday, June 20, 2026, Nokia finished its last active trading session on the New York Stock Exchange on Friday, June 19, 2026, closing at exactly $13.49 per share, marking a 2.53% drop on the day, with a light after-hours tick upward of 0.82% to $13.61. While most casual observers see this near-term weakness as just another sluggish day for a legacy European telecommunications company, the hidden reality is that this stock has quietly become one of the most heavily traded structural components in the hardware backend supporting modern artificial intelligence clusters. In fact, following a quiet $1 billion equity agreement executed by major infrastructure players late last year, Nokia has seen its optical networking and cloud segment revenue surge by 49%, completely changing the growth trajectory that standard retail investors expect when they look at this ticker. The widespread consensus surrounding this company is that it remains a slow-moving, dividend-paying relic of a bygone telecommunications boom, permanently trapped under the weight of slowing global 5G infrastructure spending. This assumption leads many self-investing individuals using basic online investment platforms to skip past it entirely, favoring high-flying megacaps like Nvidia stock, Apple stock, or Tesla stock. However, this common ground belief misses a massive disconnect between expectations and underlying structural realities. The massive expansion of massive language models and hyperscale data centers has run directly into a severe physical bottleneck, which is the sheer speed of data transmission between servers. Because copper wiring cannot handle these multi-terabit workloads without massive latency and heat generation, the global technology sector has been forced to aggressively transition toward high-end optical networking solutions. Nokia, through its legendary Bell Labs division, owns the core IP and manufacturing scale required to fulfill this demand, causing the market to revalue the company not as a failing mobile hardware business, but as an indispensable pipeline provider for the high-performance computing space. To understand where this asset is moving, we have to break down the massive technical volatility that has defined its chart over the past month. After starting the year hovering near the $4 mark, the equity experienced a massive run-up to a 17-year high of $17.10 in early June, driven by massive institutional accumulation and capital spending commitments from major cloud providers. However, the subsequent daily swings have highlighted a fierce battle between long-term institutional buyers and short-term trend followers. When a broader market sector pullback hit optical infrastructure components earlier this month, this asset tumbled sharply by over 13% in a single day, triggered by a broader cooling off across the semiconductor and hardware markets. This massive intraday volatility saw trading volume spike well past 126 million shares, which is nearly double its historical daily average, indicating a high level of institutional distribution and reallocation. This intense trading volume reveals that institutional desks are actively repositioning themselves ahead of the upcoming summer earnings reports. SIBO options data shows highly mixed sentiment building up over the last 48 hours, with a sudden surge in near-the-money protective puts balancing out the massive block call options that were built up throughout the spring rally. For retail participants managing their accounts through standard platforms like the Robinhood app or utilizing tools like Schwab Intelligent Portfolios, these violent price swings serve as a reminder that structural turnarounds are rarely a straight line upward. Many individuals engaged in online investing look at a sudden drop from $17 down to $13.49 as a sign of institutional abandonment, but deep data tracking shows that larger sovereign wealth funds and long-term asset managers have actually used these macro-driven pullbacks to build out larger core blocks of shares. The macroeconomic pressures bearing down on the entire technology sector have also left a distinct mark on this equity. With central banks keeping borrowing costs restrictive for a longer period, smaller telecommunications providers have indeed cut back on their traditional carrier network upgrades, which is the exact data point that short sellers use to justify their bearish positions. But this is where the contrast between expectation and reality becomes crucial for a sophisticated portfolio. While the legacy mobile network division faces cyclical headwinds, the enterprise infrastructure business is experiencing a secular tailwind that is completely insulated from standard carrier spending cycles. Big tech hyperscalers are spending hundreds of billions of dollars on physical infrastructure, and a significant portion of that capital is flowing directly into the routing, switching, and optical transportation hardware, where this company holds a near monopoly position in Western markets. This divergence in performance has sparked a wider conversation across major investing sites and digital communities regarding how to properly value a business undergoing such a fundamental operational shift. For example, individuals who manage an active individual brokerage account through Fidelity Investments or use the specialized tools on the Fidelity trading platform often compare this transition to prior industrial turnarounds, where the market took several quarters to fully accept that the underlying revenue mix had changed. Traditional valuation metrics look stretched if you look strictly at the trailing price-to-earnings ratio, which currently sits at a seemingly inflated 82.46. But when analysts compute forward-looking metrics that account for the high-margin software-defined networking contracts signed in the first half of this year, the multiple drops significantly, revealing a much more attractive risk-reward profile than the headline numbers suggest.
If you are tracking this through an Interactive Brokers account or monitoring order flows on the Interactive Brokers platform, you will notice that the spread between institutional ask prices and retail bid prices has remained remarkably tight despite the recent downside pressure. This technical behavior indicates deep liquidity and a strong baseline of support around the $12 to $13 range. Unlike speculative microcap assets that collapse completely when sector momentum shares, this company has a massive balance sheet with billions in net cash, an active share buyback program, and a steady corporate dividend policy that limits deep capital downside. It provides an interesting case study for anyone seeking comprehensive investment help, illustrating how a legacy brand can leverage its intellectual property to capture market share in an entirely new infrastructure segment. Let us shift our focus for a moment to what this business actually does and how its core operational model generates cash flow today, because the general public still associates the brand with consumer cellular devices that it stopped manufacturing long ago. Today, the corporation operates through three primary business segments: mobile networks, network infrastructure, and cloud and network services. The mobile network division focuses on base stations and radio access technology, which remains a stable cash generator despite its low growth. The true engine of recent stock price appreciation is the network infrastructure group, which develops IP routing software, optical transport systems, and fixed access solutions that form the backbone of modern web routing. By selling these highly specialized systems directly to data center operators, the business has successfully decoupled its corporate margins from the highly competitive telecom carrier space. Historical financial reports show that the company spent nearly a decade cutting structural fat, optimizing its global supply chain, and resolving costly internal manufacturing inefficiencies following the legacy consolidation choices of the past. This long period of structural discipline is finally paying off just as demand for high-capacity hardware lines up with their production capacity. We recently saw an excellent example of this operational agility when the company announced a $30 million expansion of its microchip facility in Pennsylvania, a move designed to secure domestic supply chains for defense contracts and high-security public communications. Furthermore, the organization has begun spinning off specialized assets, such as a recent agreement involving its space communication solutions business with Celestial Acquisition Corp., showing a clear corporate intent to create shareholder value by unlocking non-core business segments. Comment below how many shares of Nokia you currently hold, or if you are planning to add this infrastructure play to your portfolio soon. Hearing your perspective on these legacy turnarounds helps build a much clearer picture of how retail sentiment is shifting away from the standard tech names. Looking forward into the final half of the year, several distinct scenarios could play out, each tied directly to how reality continues to match up against market expectations. The primary catalyst for a renewed push back toward the $17 mark will be the upcoming corporate earnings release, where investors will demand absolute proof that the high-margin enterprise business is growing fast enough to completely offset the slow telecom segment. If the corporate margins expand by even a fraction of a percent above consensus estimates, short sellers who have piled into the stock over the last 2 weeks will be forced to cover their positions, potentially triggering a rapid upward squeeze. On the flip side, the chief risk to this thesis lies in potential supply chain delays for highly specialized optical components, or a broader macroeconomic slowdown that forces big tech firms to temporarily pause their data center buildouts. For investors building out a self-investing strategy across modern platforms like SoFi Invest, or allocating capital via a Fidelity mobile app, balancing these future catalysts requires looking past daily noise. If you look at the broader landscape of tech infrastructure, names like this present a stark alternative to hyper-valued growth stocks. While people routinely use the Robinhood stock trading system to chase massive intraday gains in speculative assets, long-term wealth management desks at firms like Fidelity Wealth Management often look for unloved infrastructure plays where the underlying asset value provides a safety cushion. The ongoing expansion of global data requirements means that the world needs more physical fiber, more advanced switches, and better network security, all of which are core competencies of this specific business. When we look closely at how the current stock price of $13.49 measures up against the broader market environment, the tension between what people expect and what is actually happening becomes glaringly obvious. The market expects a boring, slow telecommunications business that is highly vulnerable to cyclical downturns. The reality is an agile, cash-rich infrastructure provider holding vital patents and technical solutions required to make modern artificial intelligence networks run efficiently without melting down. The recent pullback from its multi-year highs has flushed out weak speculative hands, leaving the asset in a much healthier position as it consolidates and builds a technical base for its next major move. Whether you manage your holdings through a basic individual brokerage account or trade institutional blocks using advanced systems, tracking this structural divergence is one of the most compelling stories in the current market landscape. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Thank you. Don't forget to like, comment, and share this video to support the channel.